Um, I myself haven't been awake since the very morning, so I hope that gradually we'll get into the rhythm. So let's first make sure that you have arrived at the correct workshop. It's called Initiation to DeFi. As you can see, it will be largely a high-level overview of different protocols, several popular ones, and their usage patterns, and it is dedicated to non-developers. At least the first part is. Um, we'll be talking about Uniswap / Sushiswap, AAVE, and probably Gearbox if we have time. And the second one will be done by my colleague here, Alex. He will talk about Dodo, Curve, and Convex. Also, an absolutely identical workshop about the same protocols will be hosted today after lunch by the same people. Okay, hopefully everybody's where they want to be right now. So again, we'll start with the very basic stuff. It can be boring at first. Then we will dive into some developer stuff as well. So, right. Let me first start by start my talk about myself. I'm really happy to be here among all the wonderful people who contribute to this industry. My name is Ilya. I'm core contributor to GTON Capital DAO. Maybe yesterday you participated in our party in the evening. So we are one of the platinum sponsors and co-organizers of ETH to Buy. And I myself am mostly busy with like research papers, testing different models, writing documentation, stuff like that. And just a quick overview of what we've done. So several years ago, the founder of GTON Capital, Alex Pupashev, he created VenLab. So we were like a Web3 development team, and I've been working there as a researcher for several years. So VenLab created different MOOCs for Web3 developers on Stepic and Coursera, and it was a success. Lots of devs joined. So we started like with education, and so one of the crucial projects that we did was Neutrino, an algorithmic stablecoin with billions locked in TVL, and now at this point is fully owned by Waves protocol. So currently we're building a DAO which revolves around the concept of algorithmic governance tokens. I won't give too much detail about GC DAO in this talk, I just won't have time. But if you're interested, you can check us out at GTON.capital, or tomorrow you can just join our team at the booth. And is there some feedback? Okay, so this was the most important thing I wanted to say, but I screwed up. So okay, GTON.capital. Tomorrow we'll have a booth. You can just come up and talk to our team members. Yeah, we're awesome, very welcoming. So first I'd like to start by, it's interesting, like the stuff I say gets repeated. Okay, anyway, so why am I in crypto? I think the world would be just a better place if people shared more about their motivation and their intentions. So a couple of key points here. I see the current DeFi ecosystem as many sort of simultaneously ongoing experiments in governance and monetary engineering, and which all attempt to answer questions such as how do we create aligned communities, in terms of game theory, and how do we maintain corrective incentive strategies, stuff like that. So this is important because it is a way for us to see into the future, see how our society could work, cooperate, collaborate, incentivize different agents, etc. So another point here is earn and to give. Maybe some of you have heard about effective altruism. If I get lucky and earn a lot, I'd like to donate parts of my earned capital to effective charities. For instance, it is done by the founder of FTX and Alameda, Sam Bankman-Fried. He's definitely one of the people in the industry that I'm inspired by. Also, complex systems research. Every project, every crypto project gives rise to a level of complexity, either like from the interaction of people as rational agents or of models and assets as sort of dynamic systems. So, I like to look at the world through the lens of complexity, and I find this particularly interesting from the research standpoint. Also, AI safety. Some people say that blockchain could help us in AI safety research. through decentralization. Could be true. We will see. So to summarize, okay, no, that's. But all jokes aside, crypto has both experimental value, and if monetary gains come along the way, that will be nice too. Yeah, quick introduction. I'd love to know about your own incentives and motivation, but maybe we can talk about that after the workshop. So again, this workshop is called Initiation to DeFi. I think a more apt title would be Demystifying DeFi. Let me explain why. So it's dedicated to people who, while having sort of a high-level understanding of what crypto is, who use centralized exchanges, but they have not yet been able to dig deeper into decentralized finance. Maybe you've done like a swap or two, maybe you used a bunch of protocols. You know, you want to do it with more confidence. So right away, if you are much more advanced, much more proficient, the first part definitely will be boring, but then we will dive deeper into the developer stuff, so maybe that will be some, you know, of use for you. So my talk will be protocol-centric. We will review several protocols, and through that review process, we'll be able to sort of grok the most useful DeFi primitives. Right. So I hope I can show you how DeFi, you know, is a subset of the crypto world, how it is different and free and elegant, stuff like that. So yeah, and again, if you want to go hardcore, my colleague Alex will be starting his presentation in about an hour here, which will be more dev-oriented. Okay, so talking about the prerequisites that are important to know before you enter DeFi. Just understanding what DeFi is as a concept, understanding how it is non-custodial and permissionless. Just a broad understanding why you need it personally, because I think sometimes centralized exchanges, they, you know, do what they got to do, and they actually fulfill every need. Maybe you can get by, you know, just by using Binance. Uh, but if you want to try DeFi, you know, you got to be familiar with MetaMask as the main wallet in DeFi. I won't talk about it much, as I assume that it is in a way like a universal kind of knowledge. And there are tutorials, and also I think there's a workshop about MetaMask today, if I'm not mistaken. Yeah. Um, right. So let's start with the first protocol on the list. The pioneering protocol is called Uniswap, and you know, as usually is the case with large DeFi projects such as Uniswap, the name itself, it can mean a bunch of different things in different contexts. So it's usually important to clarify what you mean when you say like Uniswap. So sometimes it means Uniswap Labs, which is the company that developed the Uniswap protocol and the web interface. It can mean the interface itself that you can use for interacting with the protocol. The interface is only, you know, one of many ways a user can actually interact. Another way is, for instance, to call the functions on smart contracts directly by writing scripts. I think Alex will be showing that. Also, Uniswap Governance, a governance system for, you know, governing the Uniswap protocol, and it is enabled by the token Uni. Finally, the default meaning for today's talk is the protocol itself. So it is represented by several smart contracts on the Ethereum blockchain, and together they implement the so-called automated market maker concept. So that makes Uniswap an AMM DEX. So I will primarily be focusing on that today. And what's interesting is that in most DeFi projects, the separation into like the builders, the UI, the DAO, and the smart contracts, it exists. Same things with GTON Capital, where I contribute. And you will see this pattern everywhere. Right. So now let's see the definition of Uniswap, or like one of the definitions of Uniswap breaking down into pieces. So the Uniswap protocol is a peer-to-peer system designed for exchanging cryptocurrencies. So peer-to-peer here means that all the participants can enter into the system on equal ground, and they sort of interact with each other to produce value without any intermediaries. Now, the protocol implements so-called automated market maker as a set of non-upgradable smart contracts on the Ethereum blockchain. The market maker concept as a sort of building block of crypto today, and try to get intuitive understanding of how it works. Then there's like non-upgradable smart contracts essentially means that once they're deployed, the Uniswap smart contracts will function perpetually as long as Ethereum exists. So Uniswap is Ethereum-based, but Sushiswap, which we'll be reviewing today as well, has liquidity on multiple different chains. So if you're into using some other chains for some reasons, then Sushiswap is the project to go. All right. So let's talk a little on the point of permissionlessness. Why is it important in DeFi? So Uniswap is designed with several ideas in mind. It's like censorship resistance, security, non-custodial approach, which means that your assets are your own, and also the lack of any trusted intermediaries who may restrict access. So it means that anybody can trade, anybody can set up a pool, become a liquidity provider, etc. Not the same with centralized exchanges. People again can get censored. People can get restricted from using a centralized exchange. It happened already multiple times. So in my opinion, some of these principles, whereas the restrictions of a traditional centralized exchange do not. And although traditional exchanges, they are currently crucial for crypto because they allow to bridge the gap between the fiat world and the crypto world, they and the AMM DEXs are built on completely different principles. And to understand how AMM, such as the Uniswap protocol, differs from a traditional exchange, let's look at two aspects. So we already discussed how permissionless systems differ from conventional permission systems. And we already talked about how permissionless design means that the services are open for the public. Nobody can restrict, anybody can swap, provide liquidity, stuff like that. But now let's focus on how the automated market maker design deviates from traditional order book exchanges. So among the people here, who trades stocks? Somebody? One person? Good. So you're probably familiar with order book systems, or those of you who have used centralized exchanges, crypto exchanges. So most financial markets, they use this kind of an order book where buyers and sellers, they just create orders. Those orders are organized by price level and also time. So order books are foundational to financial systems. They work great sometimes. There are a few important limitations which sort of stand out even more in a blockchain setting. So to sort of counteract that, the Uniswap protocol proposes a different model. Instead of an order book, it uses an AMM. The particular AMM approach that is used by Uniswap is called constant product market maker, and we'll see what is meant by constant product. So if you look at this from a very high level perspective, an AMM replaces the buy and sell orders with a liquidity pool of two assets, and their price is determined relative to each other on account of the existing reserves in the pool. So essentially, when you as a trader exchange one asset for the other, the relative prices of the two assets in the pool shift, and therefore that's how the like a new market price for both is determined. So we'll review this model in more detail later. So it is important to know here that a pool is just a smart contract. So you can either use the Uniswap interface and like through the interface, you will be calling functions on the smart contract. For instance, like swapping tokens is just calling a swap function, while providing liquidity is calling the deposit function. Yeah, so just how regular users or traders can just interact through the interface, which in turn interacts with the underlying contracts. Developers, they can write scripts to directly call the functions, and that's how they can integrate Uniswap functionality into their own applications, and they don't rely on any intermediaries in that process. Right, so Uniswap uses what are called liquidity pools, but why do we use pools? So the thing about order books is they are centrally operated. They require centrally operated infrastructure. So if you try to create a decentralized version of an order book on an EVM blockchain, for instance, you instantly encounter the problem of, exorbitant gas fees. Because every time you need to change your order as a trader or a market maker, to cancel, you need to pay a gas fee for, to proceed with smart contract interaction. So not optimal for the end user at all. And if we look at the implementation of order books, that's the big problem. So so as a liquidity provider to an order book, you are required to actually actively manage your orders, continuously update in response to how the market changes. Also, with an order book, most of the market makers, they use sophisticated infrastructure and algorithms. Therefore, this sort of limits your participation if you don't have access to those kinds of scripts, stuff like that. So to sum up, if we want to create a liquidity protocol which would be blockchain native, we should take advantage of what blockchain has to offer, right? Of the inherent blockchain features. And that's how we got the pool model. There are multiple versions of the Uniswap protocol. V1 and V2 are open source and they're licensed under GPL. V3 is also open source with slight modifications. So even though V3 is currently the default version for Uniswap, most of the forked exchanges like Sushiswap or any exchange which is popular in other blockchains such as Phantom, for instance, like SpiritSwap or Pancake Swap on BSC, most of them are based on smart contracts of V2. And it seems that you can't just fork, if I'm not mistaken, you can't just fork V3 for a year. Like
no, unfortunately, the license doesn't allow it.
Yeah, just for 2 years. Maybe after that. So they just said, like, we want the community to start building it first. And then, and generally, like, the way the launch of V3 went, it was deemed a bit controversial. So their launch strategy, etc. So that's why I'll be focusing on the V2 model used by the likes of Sushiswap, for instance. Right. So let's talk about the participants of the Uniswap ecosystem. So I would say there are like 3 types of users. Liquidity providers or LPs, traders, and also developers. So I'll be focusing on the first 2. How does Uniswap actually attract liquidity providers? So they are incentivized to deposit their pairs of ERC20 tokens to liquidity pools. And then traders can exchange those tokens for a fixed fee, 0.3%. And this fee gets redistributed among liquidity providers. And that's exactly how you actually can earn as an LP. Also, there are several different types of liquidity providers. There are passive LPs. They just deposit tokens. They accumulate trading fees over long periods of time. But this strategy, it is negatively influenced by effects such as impermanent loss. We'll talk about that as well. So professional LPs are different because they can develop some sophisticated custom tools, and they focus on market making as their primary strategy. So they can track liquidity positions across different DeFi projects in order to be able to sort of reshuffle and optimize their strategies and also counteract impermanent loss. So and finally, tokenized projects where they become market makers for their own tokens. When they release their tokens, they conduct, for instance, IDOs, initial DEX offerings, and they become LPs for their own tokens to create sort of liquid markets, for their token. Right. If you talk about traders, there could be just speculators that use Uniswap-based tools and products, and they swap tokens. They use the liquidity provided by LPs, and they earn some profit. That's simple. There are also arbitrage bots. Arbitrage bots have to have a certain degree of autonomy, and they essentially earn profits by looking at prices across different exchanges, different platforms, maybe different blockchains. And when they find an opportunity to make a profit, they swap. that's how it works. So this is actually really helpful because it sustains sort of an equilibrium of prices across different markets, and yeah, so arbitrage is actually a very useful thing. So tap users, they buy tokens on Uniswap, and they use them in other applications on Ethereum. Because most of the dApps, they're actually composable. You can use, for instance, I'll be showing you how you can take a loan on AAVE, and you can actually go to Uniswap and put it into liquidity, so everything like works as sort of a money Lego, I would say. So, right, and for each type of trader, if you do a trade, you are subject to a flat fee for trading on the protocol. So for Uniswap, it's 0.3, as I said. All right, so now we've set up sort of a background. Let's dive deeper into the nitty-gritty. Fortunately, I can't point to, I don't have a laser pointer, but anyway. So each Uniswap smart contract or pair of assets, it manages a liquidity pool, and it is made up of reserves of 2 ERC20 tokens. So you need both tokens here. Some projects, such as Dodo and I think Bancor, they allow single-sided liquidity. You can just put one token, and right. So anyone can become a liquidity provider. You can just deposit 2 tokens, an equivalent value, in return for so-called liquidity pool tokens, or LPs. So these tokens, they sort of represent your share in a pool, and they are used to track liquidity shares. Think about them, they can be burned and redeemed for the liquidity for the underlying assets at any time. Right. So how are we doing? Is it good? Do you like it? I just need to drink some water. The party yesterday, it was crazy. I mean, actually, let's do like a quick set of back and forth questions and answers. Who here actually used Uniswap? What are you doing? We're talking about basic stuff, but no, I mean, I'm kidding. So who here are liquidity providers? Nobody. So you only use Uniswap for trading, right? For swapping. Okay. Just interesting to hear some opinions about why you haven't tried to put some liquidity, and is it because of impermanent loss? Is it because the rewards are not so great, or maybe somebody can chip in? Mm. Uh-huh. Mm. Mm, right. Right, right. Yeah, got it. So yeah, basically, if you do a passive investment strategy as a liquidity provider, it's kind of hard to counteract impermanent loss because you have to keep track of how much you earn in terms of trading rewards, the fees that gets redistributed. You have to sort of rebalance and understand strategically and long term, understand whether the fees that you will get will actually will actually be more than the impermanent loss that will be associated with putting this liquidity. So yeah, that makes sense to always calculate, always find optimal strategies and solutions here. But okay, let's talk about liquidity deposits. If we just zoom a little closer into how liquidity provision is done, Uniswap as an AMM is powered by a constant product formula, a legendary formula x times y equals k. So pairs, they act as automated market makers, and so the pool accepts one token for the other, and the important thing is here that the relation determined by the constant product formula should remain the same. So k is sometimes called the invariant because it's constant. So yeah, basically the formula states that the trades that happen must not change the product of a pair's reserve balances. So why was this formula chosen? This formula has a property that larger trades, it is a useful property. Larger trades, they will execute at worse rates than smaller ones. Actually, exponentially worse rates, right? So therefore, the pool won't get drained of liquidity instantly. There's a certain, although like there's a certain low slippage area where price impact is minimized. There's a certain interval of assets that you can trade without very large slippage. So basically, it also means that if there's larger liquidity in a pool, you will get a better trade, right? So for any project, like a tokenized project that starts market making, it's important to manage your liquidity, and that's one of the ways to actually manage participation of people in your project. You can tweak liquidity, so withdraw, put it back in, and that's how you essentially create a strategy for market making. Right. So. Hmm? This one? You mean? I think it's probably an error. It's just taken from the Uniswap documentation, but I mean, yeah, the math doesn't add up. I agree. I think that the reserves there are like bigger because it says here 1,210. Anyways, we'll just go ahead.
It's probably after the trade or something. Because
Still doesn't add up because it has to be 1,203 plus the fee, right? But Uniswap is open source. So you can just find their documentation and fix it. Uh, anyways, but thanks for noticing that. Right. So, where was I at? Again, you get your LPs. You can burn them at any time to receive the underlying assets. Plus, as soon as you burn your LPs, you get the proportional fee allocation that has been collected while you were an LP. So one of the important points about LP tokens is as they are themselves, they are tradable assets. You can sell or transfer those liquidity tokens in any way you want. So basically, if you send your LP to another address, they will own your liquidity in the pool. It's really important because you need to protect your LPs as much as possible. In a project setting, this would require using a multi-signature wallet if there's like a large amount of liquidity. So LPs are really precious. So talking about impermanent loss. Now, if you are a liquidity provider, you wish to earn trading fees, you may think, oh, I may put my liquidity and forget about it. Well, not so fast. There's this thing which is called impermanent loss. It happens when the price of what you deposited changes compared to when you deposited the assets in the pool first. So the larger the change is, the bigger the loss. So in this case, impermanent loss essentially means that there's less dollar value at the time of withdrawal than there is at the time of deposit. And when one of the tokens that you deposited grew, you may actually be better holding those tokens rather than putting them into a liquidity pool. So you need to always check whether the trading fees that you may get will counteract the impermanent loss. And sometimes it's just better to hold rather than deposit. Right, now let's talk about swaps. It's another DeFi primitive which is used everywhere. Just a simple way to trade one ERC20 token to another. Again, the formula itself, it states that when either token is purchased, a proportional amount of the other must be solved in order to maintain decay constant. Um, although in practice, Uniswap also applies a 0.3% fee to trades, and it is added into the reserves. So there's a little like bias there. Um, as a result, actually each trade increases K. But this the surplus, it actually functions as a payout to LPs, right? And it is realized as soon as the tokens are burned, and as soon as LPs withdraw their portion. So right, let's imagine a situation where I, as a trader, I want to sell my 3 token A. So if I put 3 tokens, the AMM needs to determine how much it will give me to keep the total product intact. So right, if there are like 1,200 and 400 token reserves, it will give me 1 token. Pretty simple. Okay, again, just room check. How's it going so far? I mean, I'm trying to understand whether you all know about that. We just spend this time for nothing, but so is there like anything new you've learned so far? Somebody? Okay, sure, sure. Can you say it again? Oh, that's awesome. Thank you. Right. So Uniswap v3 is a bit different. It actually uses what is called concentrated liquidity. So it allows an LP to set up a certain interval of liquidity, and the trades that are going to be happening in this interval, his or her funds are going to be used as much as possible. So it allows you to set up along the price curve, to set up different spots which you prefer your liquidity to be used. But I won't be showing V3 today. Actually, all the practice is going to be using Sushiswap, which still remains a Uni v2 type of project. And one of the things about Sushiswap is it is present on very many low gas fee chains like Phantom BSC. So if you want to get into trading and liquidity provision and Ethereum is maybe too expensive for you, or if you want to test some things, then Sushiswap is the way to go. Right. Do you have anything to add? I just want to drink some water.
Yes, so I want to add that actually, although this is named like Initiation to DeFi for non-developers, at my part of the yeah, we probably have to set it up
No.
back. So it's for the stream, yeah? Or okay. So now I hear myself. Yeah, and so the thing is, it's actually really easy to deal with the code with like solidity deployments, etc. Currently, so I'll be showing you how to like get the smart contracts, for example, the Uniswap P2, and deploy them yourself. So, for example, you might need this for testnet deployments to if you're building your new infrastructure and you need to test out how your smart contract is going to be interacting with the Uniswap pools. It's very easy to do so. Like it's a matter of like 10 minutes to deploy such a contract on the testnet. So yeah, I hope this would be really helpful.
Does it work? Okay. okay, as Alex said, you can be a you can write a script and you can interact with smart contracts directly. For end users, it looks pretty simple. If you are a liquidity provider, you need to have a pair of equivalent value in your wallet, and you need to deposit it. If this pool already exists, the relative value is determined already. So you have to conform to what the pool says is the proportion. So if you create a pool, you are the first person to actually determine what the rate, the proportion between the two assets is. Um, right. So for end users, swapping is also really intuitive. Uh, this is the actually like most of the projects they just fork the Uniswap interface, where a user just picks an input token and an output token. If there's enough liquidity, if actually if this pool actually exists, if it has enough liquidity, they can do the swap. So they specify an input amount, and the protocol calculates how much of the output token they'll receive. Then another thing is that they usually need to approve being able to sell their tokens and execute the swap after that, and they will receive the output token as soon as the transaction is executed. Right. So I'll be showing you all that at the end of my part of the speech. Now, let's talk about AAVE. Um, who here actually used AAVE to lend some tokens? One person, two people, three, four. Good. One person from my team. Amazing. Uh, right, so let's start with the definition again. So AAVE, we actually went through all the basic stuff, so maybe now we'll just go faster. So akin to Uniswap, AAVE is a decentralized, non-custodial liquidity protocol. Basically, it represents another basic building block or primitive lending, right? So users can participate in AAVE as either lenders or borrowers. Lenders, they provide liquidity to the market. They earn a passive income. They have to monitor their health factor. They have to make sure. Um, oh no, sorry, I'm mistaken. So lenders provide liquidity, right, to the market to earn a passive income, and borrowers are actually borrow in two fashions, either over collateralized or under collateralized. The second one happens in one block. Um, so again, the funds for loans are stored in smart contracts, so-called lending pools. Works pretty similarly. Principle is pretty much the same. So there are two basic parties, and they one provides something, another gains from it. So right. So in order to use AAVE, you simply deposit an asset in some amount, and after depositing, you will be able to earn passive income based on the demand from borrowers. So additionally, if you deposit assets, you become a borrower yourself. So you qualify to become a borrower yourself. And you can use your deposited assets as collateral. It's an interesting point that you can actually earn interest by depositing funds, uh, and it may pay off the interest rate that you accumulate by borrowing. So yeah, right, right. It's pretty normal. I mean, I think Sushi was like a pioneer of staking your LP, if I'm not mistaken. But the thing is, like with Pancake Swap, you add liquidity and they can add your LP tokens to farming and get additional reward. So a lot of liquidity providers to do that. So right now, yeah, it is quite a basic thing. So right, and the amounts that you earn as an AAVE depositor or the holder of A tokens, they evolve through time. So there's like an APY that you can sort of analyze, but basically this interest rate payment, it depends on the utilization level of your deposit, right? So actually corresponds to the average borrow rate times the utilization rate. So the higher these two factors are, the higher the yield for you as a depositor. Right, so each asset in Aave has its own market of supply and demand, has its own APY, which evolves with time. So you can use like the dashboard to find the average annual rate over a certain period of time, like the past 30 days. You can evaluate the evolution of the rate and determine if that deposit would be actually profitable or not for you. Right. So why actually borrow? Um, yeah, sure. Can you say it again? I'm actually not sure. I think we will clarify that when we see. Uh, oh, really? Cool. Thanks for that point. Yeah, I didn't know that. Interesting. Yeah, there are a bunch of details that we'll also think we'll go over. We'll be showing the dashboard itself. Can you say it again? I'm not sure. I understood. I'm sorry. Uh,
It's actually basically like the price for lending the token and the price for getting the token. So because there are two sides to this trade, so someone has to
like
write
the
the risk,
reward, yeah.
and then get. Yeah, we are good at math.
Mm. Oh yeah, that makes sense. Yeah. Okay. Yeah. Thanks for those additions. I think it's quite important. So yeah, I was talking about like why do you actually need to borrow? So for instance, you hold a certain token, and you can earn some profit when the price rises up, right? But if you sell, it means that you close your position on that particular asset. So if you want to like long the asset, um, even like further, you won't be entitled to the potential gain in the future. So by borrowing, you're able to uh, obtain this working capital and like without selling your assets, right? So usually, uh, reasons to borrow, it's either some unexpected expenses or maybe leverage or new investment opportunities. Um, right. Oh, so this is wrong slide. I'm really sorry. Yeah. Okay. So the health factor essentially represents the safety of what you deposited, and what you deposited against the borrowed assets. So the higher the value of the health factor is, the safer the state of your funds. Um, and there's a liquidation scenario, and you need to be able to protect against that. So as soon as the health factor reaches 1, the liquidation of your deposits will be triggered. And uh, so depending on the value and the fluctuation of value of your deposits, the health factor will either increase or decrease. If it increases, it will improve your borrow position, and because it makes the liquidation threshold unlikely to be reached. Right, so if it decreases, yeah, vice versa. The risk of liquidation increases. So if you want to avoid the reduction of your health factor, you need to add some more funds, like to repay the loan or deposit more assets. That will increase the health factor. So out of these two available options, if you repay the loan fully, it will increase your health factor more. So right. Actually, I'm not sure, to be honest.
Yeah, I think if it drops to 80% or something, like
Yeah, there's a certain threshold when draws below that will be liquidated. Um,
it's just to make sure that like the protocol gets its money back. So if the price of that drops radically, they have to do it. Otherwise, like they are not gonna get their money back.
yeah, so that's it. Now gonna be showing you some practical stuff. Give me a second. I need to set up the screen. Meanwhile, if you have some questions, maybe you can, I don't know, address that to Alex, because I need to do that. Um, hold on. Okay. 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 So no questions. Maybe you want to add something that I missed. Uh,
What do you mean?
to hear
What
it.
do you mean? Yeah, definitely. So there are different assets that you can borrow. Yeah, but anyway, like this is just for one of the ways to borrow money, like use them somewhere with the collateral. So for example, this is happening like when you have one asset, for example, Ethereum, but needs to make a trade in some other asset. I don't know, like well, basically any ERC20 token. So you give the collateral, you get some slower, like small amount of other token, and you can do the trade. Like if you know there's an opportunity for profit, you can do that and then return those tokens and get your Ethereum back. So basically, it's mostly used for I think like arbitrage situations, so that you don't have to change your tokens permanently, but instead of borrow them for fixed amount of time. Yeah, 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 of course. So it all depends on the market. So they have to have liquidity in that token. So yeah, this is the only way. And basically, like the different percentages that you've seen. So if there is a big demand for one of the assets, so for example, like always rate is like very high. This means that if you provide that token, your return on that token is going to be quite high. So that's why it incentivizes the people to deposit their assets.
Check. He.
Ability to borrow from.
Yeah, we can just go ahead and look at Sushi, see how it works. Right, so first and foremost, Sushi implemented a new
kind of interface, new kind of protocol which is called Trident. They actually allow to, I think if I'm not mistaken, they allow to use their own landing protocol which is called Bento Box right from the interface here in Trident. Let's start with legacy first. This is actually the interface that you will see in many different kinds of exchanges. I specifically started with like a completely fresh setup. I only have my MetaMask account here. Funded it with some tokens. So we're gonna be doing some weird combinations of liquidity pools. Give me a second. Right. So why am I not showing? Okay.
Oh, this is probably it's because of my mic.
Maybe. So why am I not showing you Uniswap? Because I want to actually use some other blockchain other than Ethereum for this demo. Makes sense, right? So right here you can find a very wide selection of different blockchains. Actually, like with GTON Capital, we started on Phantom. I think it's a great ecosystem. We're partnering with, we've partnered with lots of projects on Phantom, and probably going to be showing you, like we're going to be doing transactions on Phantom. Actually, AAVE also allows to use Phantom. Right, so since it's a fresh setup of MetaMask, I don't even have the network added. Did that on purpose to show you that as soon as you want to interact with a new blockchain, most of the projects, they actually, like right now, they allow you to, as soon as you switch to a blockchain in the app, they provide you with all the necessary like credentials and RPC, URL, and you can just approve and switch, and then you will be able to see that network and interact with it through your MetaMask interface, right? So don't look at this. I haven't backed up my security recovery phase because this address is only for the demo. I'll just won't use it anymore. So I've already pre-funded my account with some FTM. I'm going to use that to pay for gas fees here. So let's do, oh, actually, by the way, let me show you. One of the important things here is that I don't see any other assets here, only FTM, only the native token, but I know that I have a bunch of them on my account. So if I go to FTM scan, you can see there are a bunch of tokens like Curve, Band, Cream. I need to add those tokens into MetaMask to be able to track their movement and understand how much I have on my balance, right? So it doesn't work all the time, but I hope it works right now. So if you find this token on any scanner, you can actually instantly add it to your Web3 wallet, to MetaMask, for instance. So if you go here, yeah, it needs to be connected to Phantom first. Hmm? Right now they're on my address on Phantom Network. So they're just not depicted in MetaMask. So it's on the blockchain itself. That's the thing. But MetaMask just connects.
Connects through an RPC node, connects to the blockchain, shows where the amount of tokens you have. So does that answer your question? I
don't really understand that, because typically if I was doing something, then it would be in some protocol state or you know or something of that sort, right? So I can understand what is like it's sitting on the blockchain, right?
Like this. The thing is,
so for example, I saw you had something on Curve, right? So then I understand that you're doing something on Curve with that particular phantom. So is it
no, not really. So I just have some curve tokens on my address, right?
Yes. So you have done something on Curve, right? Maybe they're doing something on Curve.
I could have just bought those tokens somewhere. Maybe I've never even interacted with Curve, right? Maybe I just swapped like on Sushiswap, right? In this particular case, I just sent it from my other address. So this is a completely fresh address, so I haven't really used any protocols with it. And I just have these curve tokens on my account. Right?
If you said you have, this is a fresh address, then how is it linking to your old address and all the transactions you did there?
Linking to what?
Right?
I mentioned that I just pre-funded it with some. I pre-funded it with some tokens. That's what I was thinking. Yeah. Right. So. Okay. To go back. Yeah. Doesn't really work. So okay. Doesn't really work, but we can actually. I'm having a very weird situation here right now. So I want to import. I want to import my tokens, right? Just by using the address, but I can't do it because it doesn't allow me because I haven't backed up my script.
Back it up now.
That's
You
embarrassing.
can probably stop the stream so that you.
So you don't
Like
see
a
it.
phrase. Otherwise, like everyone on the YouTube is gonna see it.
Yeah, but I'm not going to use this address, so I'll put it up here. Okay, give me a second. I really need to do that.
Better you close this.
You read about it, there was an XD rug last night?
Sorry?
There was an XD rug last night?
Oh yeah,
Big one.
nice one. Almost like the top one all time. So the guys are a little bit screwed. We'll see if someone bails them out. Like 300 million.
Yeah, probably. But maybe they're going to return funds. So, okay, yesterday at the party I was talking to some people that are like doing some development, and basically they accidentally found a vulnerability in the account, like got like 50 million out of that, but returned it nevertheless. So yeah, there are like white hats as well. So hopefully this is a good hack and not a bad one.
I'm still doing the thing.
What sort of thing? Yeah, by the way, so the password is supposed to be like MAR, all capital, MAR 22. By the way, does everyone have laptops with you? Because, yeah, well, on my part, we're going to interact with the code, and I'm going to ask everyone to try and do it yourself. Because really, it's not that complicated. Like all the stuff that developers pretend that it's very complicated. It is actually not. So the hard part is probably like making sure that the protocol is sustainable, etc., and like little quirks, etc. But that there are a lot of cases when you need to like deploy a simple ERC20 token or something, and this can be done really easily, like from already available stuff that's already on the internet. It's easy to interact with the contract as well, so get it listed anywhere, like in case it's something open source. So good stuff.
Right. So, managed to do that. So if you don't see your token, you can just import it. To do so, the easiest way is just to go to the scanner of the blockchain of your choice to put your address or just view it in Explorer, right? And if you find your tokens over here. Like I want to use, let's say I want to use Curve right now, and I need to add it to my MetaMask. So I copy the address, go to MetaMask, and I'm importing it. By putting the token contract address, it already fills all the necessary fields here, right? Token symbol, token decimal, etc. So I'm adding the custom token, and right now I can see that the balance showed up in MetaMask. So now if I want to send it somewhere, I will be able to choose it from the menu. So essentially, what I wanted to do is just show you some simple swaps. Let's find the CRV token here. By the way, not all tokens are actually whitelisted. Sometimes you need to maybe add it from some token list, or maybe like add a custom token if you want to. If you know that this liquidity exists on Sushi, but it's not whitelisted, you need to add it yourself. Yeah. So you just find it in like basically either in the documentation of the project that of the token that you want to use, or use the scanner. But when you like an explorer, right? So, but with explorers, it's important to know that sometimes you search for a token, and there are multiple versions. And you need to make sure that you find the official and correct version, because sometimes there are scams associated with it. The tokens are named the same, but they're completely different. So you have to make sure do it correctly. Right. So yeah, let's just do some swaps. So there are some important things here. For instance, in this settings menu, you can disable multi-hops, which means that it's not going to be using any routing, so it's going to be doing a direct swap from one token to another, because sometimes it is more effective in terms of liquidity to use a more complicated route. And if you want to trade directly only in a single pool, then you need to disable that option. Then here's slippage tolerance. So slippage basically happens when you initiate a transaction, and the price in the pool changes, and you can get a lower value or a higher value depending on what happened between the time of the initiation of the transaction and its finalization, right? So if you raise your slippage tolerance to a higher level, you actually can be prone to different kinds of attacks, like sandwich attacks, where so when you initiate a transaction, another actor, like malicious actor, can initiate other transactions, which will be changing the price in the pool, and you will get a lower value essentially at the very end of it. So that's why you should be careful with setting your slippage tolerance. So basically, slippage and so if we like just theoretically try to swap like a large amount, you can look at the changes here in the price impact factor. Price impact essentially shows how your own trade will affect the value in the pool, right? So price impact and slippage are quite similar, but really not. I mean, price impact is about your own trade, and slippage is about the trades, all the trades that happen in the pool, except for your own trade, but that can influence the result of your transaction. Also, when you do a swap, the DEX, it actually guarantees that you will get a certain minimum, and it depends on your slippage setting. But if the amount that you will get as a result of your swap falls below this level, it means that the transaction will fail and will be reverted, right? Also, here it shows the liquidity provider fee that we discussed. It's what you will pay into the pool that will get redistributed to different LPs, right? So for instance, if we as you can see right now, I can't do like a direct swap of curve to sushi. It says here that the price impact is too high. There just isn't enough liquidity, right? So if we enable multi-hops, we can see that it creates a route. So it will do several exchanges, right, through wrapped FTM, USDC, and then sushi. But we can find some other token which has a higher liquidity and just do a swap. So first and foremost, I have to approve the usage of my CRV to the smart contract. So let's do just that. So we need to sign. Wow, new gas experience. Cool. Haven't seen it yet. So I'm giving permission to access my curve token. Pending. What's up with Phantom? Is it okay right now? Does it work more?
What's
No,
happening?
that's okay. No,
Yeah.
I just
No,
asking.
Phantom mostly works. If I face issues, it's mostly on Polygon, unfortunately. All the
yeah.
time.
I talked about Polygon yesterday with a bunch of people. They all said like, what?
Basically, the transactions don't go through, like get lost, etc.
Yeah.
And yeah, unfortunately, this is the quirk of Polygon
Yeah.
in general.
But it happened with Phantom like like a month
Yeah,
ago.
with one, okay, it's happening to
Every
like basically every chain
yeah.
now and again.
So yeah, let's just try do the swap. Actually, if you enable an expert mode, I think it doesn't show you this window to confirm. Interesting. It says here, not a number. I think I found a bug in the front end of
Or maybe it's
Sushi.
like the dots instead of something.
Really?
Yeah, because it's sometimes the comma, sometimes the dot. I'm always confused with that.
No, I mean, I'm trying to swap like one curve. It doesn't.
Let me see. Let me debug this for you. But it's just to confirm swap.
No, that's okay. I'm
Probably
just interested
it's a
in
none
this.
for the percentages. So basically, they've got something off with their math.
Yeah,
and it happens
that
in
happens.
JavaScript.
Hmm? Okay, let's try.
Yeah, I think it's just an issue with that particular calculator. But anyway,
Like
like
still doesn't work. I'm
yeah,
not sure why.
it
Maybe
should
it's because
be.
of maybe it's because of Brave because it like uses
Oh, maybe as well.
right. So finally, yeah. So here I can manage my gas fees if I want it to happen more quickly or
Or risk losing the money, the gas fee.
yeah.
Because yeah, you learn it the hard way. So if you send not enough gas, especially like on Ethereum, your transaction is gonna fail and you're just losing the money. All the transaction fees are gone. Yeah, and it's better to do it on the start. Yeah. And especially like also when you're dealing like with programmatically like sending transactions, sometimes yeah you can fuck up and unfortunately send like too much gas, for example. And of course the miners are easily gonna eat it, no problem. So be careful, like. Yeah, some of them do.
Yeah, like for instance, if you wrap your token through Seller Network Bridge, it will always
the native token of the target chain in order for you to be able to use it. So I think yeah, that's a nice gesture. Right. So yeah, transaction submitted. We can see it in the Explorer. We can see how much we gave, how much we got, the contract we interacted with, the gas fee that we paid, and actually we can see the exact signature of the function and the data that we sent to the smart contract of Sushi. And yeah, basically it also allows you to add the token that you just swapped to to MetaMask and use it somewhere else. So yeah, maybe we can also add some liquidity. No, no. Add. So just find some combination. So if there is no pool existing, we will be creating it. But if there is some liquidity, then we will just have to put the amount that's already provided in the pool in the exact proportion. So I don't know. Let's do some here. Actually, I think Phantom and Sushi has generally low liquidity. So maybe we can just add some. So it does show the share of pool. Actually works pretty much the same. You can tweak your slippage tolerance setting. Yeah, right. So let's just try to do that. So the important thing to note here is that some new tokens actually were minted. In Sushi, they are called SLP, or Sushi Liquidity Pool tokens, right? So these tokens, it's not that easy to actually manage them. You can also like import. If you go to your address, let's just do that. So it's from, where's from, yeah, it's here.
Yeah, basically what's happening, like when a new pair is created on chain. So for example, someone creates a pool of 2 tokens on Sushi, and basically deploys a new contract that's got its specific address. And this contract itself is an ERC20 token.
Yeah.
So basically that's why you can easily like transfer it, like deal with it, like even in MetaMask. So for example, if you import this particular address of the pool and you've got the LP tokens, then you can just click on it, transfer, and send it to anyone else. Of course, you're losing money in this way.
Yeah, so this is the contract, the SLP. And they represent the share in this particular pool. So for every pool, as Alex mentioned, there's a separate SLP. Right, so any questions, anything you want to get more in depth with, and just let us know right now.
All your FTM tokens at one place. Where was that? I'm just trying to. Okay. From MetaMask. This one? Or I was just trying to do it for myself.
And in the meantime, your question?
Yeah, so is the slippage basically how much you're willing to get front run?
Yes, basically so.
Because I was thinking like if you put in a trade, right, and say when you put in a trade, miners can look at the block, approve the block, right?
Yeah,
so
exactly.
when they see your trade come through, let's assume you've got a thin liquidity pair, then what they can do is they can wipe out the side of one of the liquidity to effectively the price difference that you're trying to put in there. They could then they could bind the pair themselves, wipe out the side of the liquidity so they can screw themselves over, but they know that you're plugging the gap with your trade that's coming in,
Yeah.
you're bringing their tokens back in value, and then therefore they can then pull their pair out and profit off your trade, so they can literally make you lose a lot of money.
Exactly. So, and I'll show you an example of that because I was doing a trade of our own token recently. And if you interact directly with the pool, so there are people like bots who are really monitoring the mempool, and if they see this particular type of buy order, then they just buy up the pool before you. So it was happening in Phantom, and the guys from around me buy like I think 4 blocks or something. And basically, after that, my transaction failed because I was out of the slippage tolerance. So for these purposes, actually, to use aggregators and not like work directly with the pools, because aggregators find like the best route so that you like basically don't get front run. And
Are you able to interact in the same block and change your slippage on the fly in the block? Because
well,
liquidity on one side of the pair, and then you screw them over by then tightening your slippage and leaving them hanging there with a really dodgy bind.
yeah,
And
pretty
then
sure.
you then intersect second trades to then wipe them out on their trade.
Yeah, that's basically what arbitrage brokers are doing. So yeah, they try to do
So how do
so.
you prevent that? Because obviously, if you say if I'm like doing a launch of a token, the last thing because this is where I think this will probably be quite sketchy. So if you're doing a token generation event, so you're just launching your new project, and you're binding your pairs with like you want to get other people to invest in your project. So say you're like shit token A, and you want people to buy shit token A, then you've probably not got a huge amount of money in your treasury yet, because you're just hoping that people will come on the token. So then you're really at risk of people just like really messing around with the value of your token on the swap platforms. So how do you prevent that kind of abuse when people want, because you're going to have a load of flow of people buying into that token once it goes on chain. So how do you prevent all of the people who mine and rearrange blocks just completely screwing up your investors?
Yes, so basically, if you're not. Oh, yeah. Okay, so in general, the question was like how to organize the token sales so that if you create a liquidity pool for a token and like people start to buying in, so how to make sure that someone else doesn't like drop the price of the tokens and basically removes all the liquid tokens out of your pool. Is it correct? More or less. So yeah, that's why actually I think that launching through liquidity pools on AMMs is not the best idea, because this is exactly the issue that you're going to face. So there are other options for raising the money. So different routes. So for example, what we've done, we've created a token, a contract where anyone can deposit like any amount of like whitelisted liquid tokens that are of interest to us. So for example, all the stable coins. And then like there is an allocation for like these early bird people who are invested in that contract, and those tokens are proportionally distributed between like all the deposits. And that's why we've done it in stables, so that it's easy to calculate like the exact share that they're depositing. Also, there are other ways that I'm going to talk about, but there are instruments that allow you to make like pools where you can provide single-sided liquidity.
PMM pools.
Yeah. So yeah, one of the platforms that does that is Dodo, that I'm going to talk about, and basically you can deposit only the token that you've created and set the price. The price is basically controlled by an oracle, or you can just put it yourself there, and then. Yeah. So no liquidity needed to start the token sale. So otherwise, like if you're launching the token like on an IMM and expect to raise some money, then you basically have to already have some money, and this is not the case like for the project. So that's why like different launch pads are working, and that's why there are instruments that you can use like the PMMs.
Yes, that's exactly what we did with GTON. We actually launched on a Dodo pool first, and people are starting to bring liquidity there, and we set up an optimal price. And I think Alex will be talking about PMMs and Dodo, so in more detail. I actually only have 3 minutes left, I think. I need to show, like, let's do it quickly. Let's do something on AAVE. So yeah, AAVE actually hosts their front end on IPFS, which is nice. we're doing pretty much the same thing. And I have some CRV token. Okay, so AAVE also exists on multiple blockchains. Let's try to use Phantom here. It's actually a new version of AAVE v3. I'm not sure what it. Yeah. Right. So let's just do some. So it already shows me the API I can actually expect from depositing this particular token. We also do the approval and supply. So as you can see, they already minted some A tokens for myself. It's called ACRV. Can add it and manage. Now, as soon as I supplied some assets here, I am qualified to borrow some of them. Try to do that. So it will correspond to the if I borrow at the same sort of value, if I don't actually put into consideration the risk of liquidation, then they immediately state that liquidation risk is high. So they recommend to borrow a lower amount. And they compute the. Yeah, right. There's actually two kinds of. I can't hear. I'm sorry. When you lend to the platform, you got a 3% plus APY. Yeah, right. But while you're borrowing, you're only paying 2.67%. Yeah, right. So you're actually arbitrage. You're actually getting money. You should the other way around, right? Borrowing should be higher than lending. So that's what I told previously, that you can actually deposit and pay and receive some interest rate from borrowers, right? And actually borrow and pay out that particular interest rate. And if there's a discrepancy between the two, you can actually balance it out in a way that would pay out your like whatever interest you have to pay, right? So that's one of the strategies that people can use. Has somebody done a protocol where it automatically balances out the borrowing and lending rates and just gives you the difference? Yeah, sure. So I'm being asked to just repeat your question. So you asked whether there are some protocols that automatically nullify the difference between borrowing and lending and just ask you for the difference. Actually, I'm not sure. Have you heard about any protocols that nullify the difference between the borrowing and on their own, rather than you having to do two steps?
Yeah, I'm pretty sure that there should be some aggregators, but yeah. And I think there was some question about like the arbitrage on the lending platform, and I've heard stories of it as well. So basically, there are cases when you can borrow the money from the service, and then deposit the same money on the same service and get higher if you, yeah. So yeah, it's possible to do so. But basically, the assumption is that the market is going to correct that. So it's not going to be like an open position for long, and people won't be able to do this kind of things indefinitely. Probably so. Yeah, I've heard like the stories of like millions of dollars being borrowed from the platform and deposited back into. I'm not sure. I don't exactly remember the details, but I'm pretty sure like there are definitely people that are doing that, and they are monitoring for such opportunities, and they try to get the money and get the return this way. But I think that's why the API is supposed to be dynamically adjusted, so that it's like you're not.
Actually, AAVE, I think it gives you two options. you can either go with a variable or stable APY and actually consider that in your long-term strategy. Which one makes more sense?
Yeah, and that's why, like, for long term, you can probably get less fee. Yeah, but anyway, yeah. So there might be such opportunities, but like people are doing this, all of this stuff automated. So if you try to do this manually, and especially like on bigger chains, most likely you're not gonna find the opportunities. uh, Yeah, I think so. You can just go to the pool and basically like look at the one particular token, because yeah, the conditions may vary.
So yeah, actually, you can use the markets here to analyze all the different assets to clarify which actually it really works on the supply and demand principle, right? So for each asset, there's going to be a different supply and demand in terms of borrowers and depositors, and that's how you can actually, by considering different assets, um, you can find the one that suits you the most, right? So on FTM, there aren't that many options, actually, to be honest. But yeah, so just to show you the principle, I have some AAVE tokens here, right? And I also have, I just borrowed some DAI, and I can just go ahead and use it wherever I want. So yeah, unfortunately I don't have much time left, but actually I don't have any time left for my presentation. But hopefully, just to get the gist of how it works, I hope it was helpful. Maybe some other questions before Alex starts his own part.
No questions. So yeah, we can switch then.
Yeah, sure.
Не забудь. Забыл свой провод. I'm going to talk like briefly about the curve convex and Dodo, and then I'll show you how to run your own like forks of basically any tokens and how easy it is to deploy to any chain right now, like EVM chains, of course. Yeah, but let's start with a brief introduction of myself. Let me find, yeah, the presentation. So, do you see it? Yeah, nice. So this is me. Okay. I need to do the trick. Google. Okay. Doesn't change. My trick. Okay. Okay. Yeah, makes sense.
Yep.
And it didn't work. But anyway.
You want to log in or?
Let me see. Let me. Maybe this is how you present.
Yeah,
that's how you log in. Okay. Okay. Here it is. The English. It doesn't switch the language, fortunately. Come on. But anyway, okay, let's just use another user. So here, for example, yeah. Okay, so my presentation is about, it's showing. Okay, it's about Dodo, Curve, and Convex, and my name is Alex. I'm as well working at GTON Capital, and basically I'm a development lead there. So I'm running like the development processes, improving everything, like doing code audits, and in general, am involved with the development as well. So participated in smart contracts creation, a little bit of front end, etc. when needed. And my background is actually not in computer science, so I've got the management and marketing bachelor's from Graduate School of Management and St. Petersburg State University. Then I've got my master's from London School of Economics. It was closer to like computers and stuff with like degree in management, information systems, and innovation. After that, I worked briefly at Google, but since I've got business education, I was basically at the starting position where everyone starts. It was customer support, so I was talking to people on the phone, etc. Like a phone, email, chats for 1.5 years. It was like the first time that I was talking so much on the phone, so I've never spoken that much in my entire life. But then I've decided that I don't actually want to pursue a career in that sphere. In general, like the corporate stuff wasn't of that much of an interest for me, and especially given the fact that Google already at the time was quite a big organization, and like I realized that the time it took for my like senior colleagues to grow is going to be exponentially more for me. So I would have to spend more years doing the same stuff, same boring stuff, up until I get promoted. So then I left, and actually the first projects that I was working on, I wanted to get into the startup sphere. So I was on the business development part with our founder Alex. So it was one of the projects that we've done with a friend of ours. It didn't take off, but anyway, like it was a good starting point. And then, like when I left, I didn't know what to do. So for half a year, I wasn't doing anything. Then I contacted him, and we decided to continue doing some sort of development work. I was supposed to be looking for the client, etc., and he was supposed to be the coder. But there were no clients at the time, so we've decided to do our own projects, applications, etc. So I started gradually doing some development work. So that's how I became a developer myself. And like I got a lot of experience with mobile development, iOS applications. This is my main role. Also, I was leading a team of developers, iOS and Android and stuff. And I think this experience really helps when running teams, especially like the new like startup-ish teams that we've got in DeFi, with this experience of like development that is not connected to blockchain, but at the same time, you know how to set up processes so that people, the developers work and deliver, and the code is like readable, easy to use, and so that anyone can pick up and work in the code base that's been developed by other developers. So recently I've joined GTON Capital, and currently I'm very involved with the development side of things. So we are launching some DeFi initiatives. We've got the staking contract live already for the, well, basically our organization is a DAO, so we have to replenish the treasury somehow. So we're creating the bonding contracts for that, but it's not the insane bonding of like Olympus DAO, all that unsustainable stuff. It's not for us. So we are with reasonable APRs, and we try to build a sustainable system where the company can survive for long on the treasury that we've got, and actually expand, like create new projects, etc. And so what I'm going to be talking for you today is, I think, going to revolve around the experience that we are having. So because we've got like some treasury funds, and we have to manage the price of our tokens, we need to make sure that we don't lose the treasury funds, because like when we done the token sale, I've got some funds. It's like $4.7 million, and the majority of these funds are only for market making. So our burn rate for the salaries and stuff is pretty low, and the only purpose of this money is to make sure that the product gets developed good and that we can maintain the token price somehow. So because of this, well, currently we are dealing, of course, with the funds on AMMs, but we're creating a new protocol that's called Pathway, and it allows us to set the token price instead of like the market arbitrary setting the price, because you cannot always control that, and we don't need like some FUD or FOMA to affect us too much. So that's why we're creating a system where the price of the token can be linked to the fundamental factors such as like the liquidity that the protocol owns, or like the number of whale users that we've got. So we can look, for example, on on-chain data and see if like 10% of like accounts that are of interest to us hold GTON, then it means that we've got a bright future ahead of us, and this should somehow affect price. Yeah, but the problem is like if you try to set the prices on AMMs, it's really hard to do so, and it's a system that can be easily played with by arbitrageurs. So unfortunately, those guys, when they see any opportunity for the funds, they don't care. They just go ahead and try to empty a treasury through swaps. So we've got the algorithm that tries to keep the peg price in place, but when we were trying it in prod, we've got some liquidity on Phantom with wrapped FTM and USDC on different pools. And basically, when the price was going up, because of our actions, it was like automatically dumped back to the levels it was, because people can buy low, sell high, even if it's like a little bit of money, but if you do it constantly, you can like empty the entire treasury pretty soon. So that's why we've been looking for other options of how to deal with liquidity provision, and so that the treasury isn't emptied and it doesn't affect like the mood of the investors, because of course when the token price goes down, especially like on low liquidity, it might happen. So for example, there is a bigger account that sells. If the liquidity on AMM pool is low, your price is going to drop dramatically. We don't want this because it's like and got self-reinforcing effect. So if it starts, it might never end, unfortunately. So that's why we've been looking at one of the options that I already mentioned today, and is Dodo. That's doing the what's called proactive market making algorithm, and it's a very interesting thing, because it basically like the demand and supply parts are decoupled, so that first of all you can deposit different tokens. So you don't have to provide like the pair of the tokens. If you want to be a liquidity provider, you can like deposit only one side of it, and yeah, you can easily earn money out of all the swaps that are happening on the platform. And at the same time, there is a possibility to affect the price and the slippage of the trades, so that you've got basically control of how exactly the swaps are going to be executed. So you can do it with the same pool, and you can go anywhere from between the stable swaps, like when the token prices doesn't change on every trade, up to like the AMM model, where it behaves just exactly like the Uniswap pools or Sushi pools, etc. All this stuff. So it's very interesting, and I think it very much fits what we aim to achieve, because with this flexibility you can really make sure that the price stays the same. It doesn't go below the levels you want. It doesn't go too much high, because we want to make sure that with each trade we've got like liquidity of the protocol increasing, and not the price increasing, because we want to be in control of that. But anyway, so I think it's a bit hard to explain exactly the difference of those two types of swaps if we don't talk about the stable swaps. And basically the pioneer in this is Curve, because Curve realized
at the time that there is a big opportunity for different types of swapping operations that work good, much better for the assets that are supposed to be similarly polarized. And if you take, for example, two tokens that are pegged, or try to be pegged to one US dollar, then you do not need these big price swings that you might see on Uniswap. Because on Uniswap, basically, the more token you buy, like the price can go like really exponentially, really fast. So for the stable swaps, it's not what you need. And basically, there is a different math. So compared to what Ilya was telling about Uniswap, it's basically a different curve that allows you to make swaps that try to keep the prices the same up until the change in volume is really high. So here the graph, you can see that this is basically the line of the Uniswap invariant that we've been talking about. And if you take a look at the curve that that's happening in curve, basically you see, so if the prices initially are similar, like one-to-one, one moment. So here's the point of equilibrium, and everything is well. You can exchange one USD for like one USDT for one USDC, for example. Then if you change the amount of token that traded for Uniswap, for example, the price increase is going to be much higher than for this different curve of the stable swap invariant. So that's why, like, for swaps of similarly priced assets, it's much better to use these type of swaps instead of Uniswap. And this a really good market because basically the stable swaps were not existed at the time, but at the same time there were many players that were trying to play the USD-pegged asset game. So, and at the time it wasn't clear which ones are going to survive, which one is not. So that's why you need some sort of instrument that allows you to swap between those assets easily, to manage your risks as well. Because there were, like, for example, issues when Tether was depegged on Binance for like a couple of weeks, and no one could do anything about it. So this type of situation can lead like to very big frustration, especially like if you get back like 80 cents on a dollar. It's not very good. So if you've got your portfolio spread between different assets that's got different collateral strategies, or maybe some of them are algorithmic, then you can do so using instruments like Curve that allow to do it with like little slippage. And yeah, so this is a great instrument for that. I'm not sure that it's worth actually going through the interface, because if you need to make a swap, it's really easy. Like of course, you go there, you enter the amount you want to swap, it shows the fee, etc. So it's nothing different from the instruments that we've already discussed. What I wanted to talk to you about is basically the interesting strategy of like community building that Curve has done. And basically, if you've heard of Curve Wars, is basically like the way for different protocols to try to fight for the rewards that Curve provides. So basically, when you lock liquidity on Curve, you get CRV tokens, and these CRV tokens represent your position. So initial intention of Curve was to get people to lock these tokens to get the so-called VE CRV. Basically, it stands for vote escrowed CRV, and with this lock, you are able to be casting your votes for like which stable
pools are going to get more incentives out of like the an emission of CRV token that's currently happening. So there is a mission schedule for the CRV token for 300 years. So they are thinking ahead here. And of course, like the majority of tokens are getting distributed now, and then like over time, the amount of rewards is going to decrease. And basically, these CRV tokens are the incentive tokens for liquidity providers, so that they don't get only the money from the fees of the swaps that are happening with the liquidity, but at the same time, some other incentive that this CRV token, it basically has some price, and it can be either like exchange for more liquid assets, like stables, for example, or you can also like reinvest it, lock it back at curve, and like vote for the pools that you are staking in, and basically get more money out of it. But it's interesting that given these mechanics, some smart people came up with their ways of actually not really gaming that, but taking this to an advantage so that people can have more flexibility and care less for the money that they deposit, and at the same time get bigger rewards. Basically, the main problem of VE CRV token is, for example, you get the maximum rewards if you deposit the tokens for 4 years, but you have to realize that the entire DeFi exists for 3. And basically, you lock a tokens for a lot of money. Also, they are diluted over time, so you don't have any flexibility here. You cannot transfer those tokens anywhere. So, and this is one of the main issues, again, because if you lock the CRV, it's permanently locked to your account. So basically, for 4 years, you don't have access to the funds. All you get is like very high rewards. Even if you go, for example, to the Curve website. Okay, so we have to connect here. Yeah. Come on, what's happening? Yeah, and it doesn't switch automatically. Okay, so anyway, here you can get the information on like the rewards that are happening right now in real time, etc. Where the currently all the rewards are concentrated. So basically, if you've got liquidity in that pool, you are going to get high rewards. And yeah, so what I was talking about, yeah. So the thing is, the initial VE-CRV model, it's like a little bit less flexible for liquidity providers. So people came up with an idea of like pooling the funds together so that you can get some other tokens, high rewards for it, etc. And at the same time, the tokens might be transferable. So currently, the winner of the Curve wars, and basically the wars for the emissions of Curve tokens, are with the Convex protocol. And so what they've done, so basically, you can get your CRV tokens, but stake it not on the Curve website, but on Convex. And this makes it so that the guys deposit the CRV on your behalf, but on their own account, and they always deposit those funds for like 4 years. So they do restaking, etc., all on your behalf, so you don't have to worry about it, and you basically get the highest amount of rewards out of the, like this big pool of people who have deposited their CRV over there. And this is this way, even you don't have like a lot of money to get high rewards, but you can do so depositing it on Convex. At the same time, they also provide additional rewards in the Convex token, and there is an interesting thing called bribing, where you can basically get additional rewards when you cast your votes on Convex. So Convex serves as a proxy for your votes. So basically, you decide which pool to attribute your CRV votes to, and then they cast the vote and provide you with some additional perks if you voted correctly, like for the tokens that provide incentives. So for example, here you can see that the Frax has got like a majority of the curve DAO incentives, not the majority, but like the biggest part, 20.2%, and that's because they provide bribes for those who vote for them on Convex. So basically, if you cast the vote, like which can be done once per protocol for one protocol per epoch, then at the end of it, you get some additional rewards. For example, in this case, like in Frax tokens, and if protocols wants to get bigger exposure, get bigger rewards in CRV tokens, then they can do so. Also, funny thing that currently Frax is getting more money out of CRV tokens that they're getting from their pool compared to the amount of bribes that they are giving away. So basically, they can like deposit 10 million USD for bribes and get like 15-20 million out of it. I don't remember the exact figures, but yeah, it's funny that the rewards are basically in a token that might change in price over time. But currently, it seems so that CRV token is getting a lot of traction, so it grows in price. And if you do your strategy correctly and manage your funds correctly, so you launch a new token, you list it on Curve, you might actually, so first of all, attract more people to using your token, then get more rewards out of it, even if like there are not that many swaps, but basically if you've got enough CRV for the actions that you are doing, then you're all set and you're profitable in this bribe investment. Yeah, and so, but anyways, so a Curve, like V1, V2, etc., they revolve around this stable swap invariant with some modifications for tri-pools, so-called. So basically, these are pools of 3 tokens where you can deposit like 2 liquid tokens and 1 of your own, and this way you can get a good market for the token, because any token listed on CRV is basically getting a lot of attention, and traders can see the opportunity of like dealing with your token. If there are several pools, they make arbitrage, earn out of it, and everyone who's depositing liquidity is getting constant flow of money in terms of the fees for the people that are the end users that are using Curve for the swaps. Also, it's interesting to know, so if you take a look, for example, at protocols like Curve and Convex, like at one point of time, at least I remember, like in December or something, the TVL of Curve was at around like $24 billion, TVL of Convex $20 billion. And well, of course, as always in DeFi, you have to realize like this is not all real and liquid money, and like TVL that Convex has got in CRV counts to both of them. So, but the main market for this entire like some sort of pyramid, if you think about it, because like there's one protocol and another protocol on top of it, but all of them might count the money that they've got like basically locked in each other as TVL. So it's interesting to see that basically the the base of all of those protocols is Curve and its use case of people really using it and doing some swaps, and basically the inflow of like real money comes from, I would say, the swaps itself, the fees of all the trades, and there's a lot of value that's a bit on the side, and it's the value of the CRV token, which is not directly attributed to the swaps and to the real money made on the service. But anyway, we from here. Okay, I've got some tools that you might use. I'm gonna send you the link to the presentation later, and you can take a look at the resources that I've mentioned here. But there are interesting instruments like impermanent loss calculators for like uni sushi style pools and for crypto pools. So we've already mentioned impermanent loss, but yeah, we didn't talk too much about it. But when you provide liquidity in any of the protocols, the problem is that you deposit 2 or 3 assets into the pool, and when the prices change, you can, it actually leads to the fact that people try to buy that the higher priced token from the pool, and this way you end up with more of the cheaper tokens and less of the higher priced tokens. So this is called impermanent loss. In theory, like if the prices are more or less in the market, they fluctuate but stay the same, it's not a problem, especially for example, the pools on StableSwap platforms like Curve, then it's a non-issue because you expect both tokens to stay relatively the same price, and impermanent loss doesn't affect you. But if you've got, for example, the 2 tokens that fluctuate a lot in price, like for example Bitcoin and Ethereum, this might really affect you, and when provided liquidity, you really have to incentivize by something other than the trading fees, because like if there are high price swings, then you might end up really losing the money in like dollar equivalent. So that's why, of course, some of the protocols are trying to bribe you, but not in the way of convex style, but I mean in their own platform tokens, so that these tokens got some market of its own, and you are getting the fees plus this token, which might amount to to more money than what you might potentially lose on impermanent loss when you are providing liquidity. Anyway, we can switch to like the main event of an interesting kind of new protocol, because not that many people know about it. It's currently relatively low capped. It's called DODA. And this is a very interesting approach to market making, because it allows you to basically proactively influence the price of the tokens on your pool and adjust the slippage accordingly. Well, it's been up for quite some time, and actually if you go to the DODA website and try to trade, so it's got a very good like routing system that allows you for swaps that are cheaper than on the alternative. So for example, like I can show you what the price difference of the swaps happening here and on other platforms. So for example, for our own token GTON, it's actually not listed straight away here, but yeah, I think I've been adding it manually, and so you can see the swaps from BUSD to GTON.
Okay, and let's compare it to Pancake Swap. Okay, we're going to trade swap, and we try to find the pair that we need. Here it is. And enter the same amount of tokens. And see how much 2 BUSD, 10 BUSD, 5, 15. Okay, so you see for the same swap, here for example, on Pancake Swap, you can get 515 GTON versus like 515.8 here, 515.4 here, 515.8 over here. So the guys are basically like serving as an aggregator as well as like a good platform for launching your own tokens here. But basically, like the main stuff. Oh, yeah, you see, GTON going up surprisingly on BNB chain, which isn't our main chain currently. So we don't have that much liquidity, and basically that's why like any purchase of GTON here affects the price somehow. But anyway, so the guys got really really good routing system that allows for better prices for the tokens you're buying. Although you have to take into consideration the fact that these sales can actually be costing more because of the smart routing, of course. So yeah, here's the same example like previously, or when I was trying to do some swaps, and yeah, see the price difference. But let's compare the transaction of the Pancake Swap, which basically is Uniswap fork at its core, and it's very simple routing, and you get your final token the way like you want to go. And the transaction fee for this operation was 0.37 cents. I've done the same transaction for similar amount of tokens, and with DOTA, and it cost 1.23. So probably it's not going to be profitable for smaller trades, but for higher trades, especially if you got better rate, you can take this into consideration and buy through instruments like DOTA. Also, yeah. So the thing is like what's happening here is the routing is smart. It tries to give you the better price, but every additional call on any blockchain costs additional amount of money. If you compare the 3 transactions that were happening in here to the like, I don't know, like 10, 11 transactions over here, that's why we've got the increased price, and basically it's like increased threefold over here. What? Yeah. So this is the model for the aggregators, and actually, like my advice is to always use aggregators instead of like simple trades or with the pools, because as I mentioned before, there are big front run issues. So anyone can try to change the price within your block and like try to at least hit your highest slippage, so that they price. Yeah. Yes, so this is exactly what happened here. So I was going to show you. So basically, I was trying to make such a transaction to buy GTON off of the pool. It was Spirit Swap on Phantom, and it failed. So basically, what happened? So I sent the transaction with like these parameters. There's a parameter called amount out minimal, and basically this is what sets the price tolerance for you. So this is the minimum amount of tokens you are supposed to get for transaction to go through. But what happened here, like you see, this transaction failed on the block like that ends on 607. Okay, so here's the transaction that happened on block 601. So basically, the guys looked at the mempool. I've seen my transaction. That is not for such a big amount of money. It's like It was at the time like 250 USD or something. And they tried to buy like small amount of GTON, so that when the price goes up, I have to they can basically dump it on me somehow. There's also really interesting things. So if you go to the Explorer and okay, so let's for example check the Explorer of our own token. This is the staked token contracts, and we can check the original GTON. It's not GTON, stake token, yeah, staking token over here. So basically, what I like to do is like come here sometimes, look at the transactions that are happening to our token and see irregularities. So, for example, there are some people that try to constantly buy GTON at lower prices and try to sell it, but with a gap. Like, for example, the gap might be around like 1 day or so. And so they do it in constantly for, I don't know, for like half a year already. And so this is like small time arbitrageurs, but they're taking some profit on it. And also the same happening on all the trades that you're doing. So for example, when we tried our pathway implementation that was working with IMM pools, and basically what we do, we change the liquidity in such a way that the price goes up. So for example, we remove the liquidity from the pool, make a small trade so that the price is basically changed in the way that we've got the desired price for GTON token, and then we put the liquidity back in the same proportions that are currently in the pool, so that the price stays the same after our small trade. So basically, we can move the price this way easily, like anywhere in the world. Actually, anyone who's got the liquidity in the pool can do so. So you can theoretically set any price in your pool, but expect it to be corrected straight away with the people that realize this opportunity. If they see that you constantly do it, they're going to buy low, sell high, and basically you're going to lose your liquid token. So you're going to be the one who suffered the impermanent loss. You've got more of your own token in the pool, less of the liquid token. So for example, USDC in our case. So yeah, and when we were trying to do so, we of course saw that people are instantly selling GTON, like even in the same block. So for example, we make the change, the price change, and like some of the guys react in the same block, some guys like in the doing some trades in the following 10 minutes. So people are constantly trying to make money of everything on the blockchain. And you have to realize that this is happening not really like someone manually monitoring it. So it's all done automatically. It's all done on like basically all of the interesting tokens that got liquidity. So when providing liquidity, when dealing with the pricing of your own token, you really have to pay attention to the market situation. So you have to be prepared for anything that might happen, etc. And like you cannot just leave your token unmonitored. So that's why, as I was telling you, we, as we thrive to try and control the price of our token, we are switching to the instruments that allow us more flexibility. And Dodo is this exact instrument. Oh my God, I can see myself. Yeah, Dodo. So interesting thing. So I can show you the experience that I've been running.
So just to mention about, were you talking about arbitrage on Phantom that we experienced, right?
Yeah.
So there are like only a bunch of addresses that we just analyzed on chain that actually take most of the arbitrage rewards. So they have, I think they have some bots. They maybe look in mempools of nodes, and that's how the. Can you hear me okay? No. Yeah, that's basically how they get this advantage always. So you have to manage your arbitrage strategy when you launch a project on AMM. So basically, that's what I was trying to tell.
Yeah, and so the DOTA is an interesting instrument that is very well suited for the token sales, for example, that we talked about already, because it allows you to easily deposit only one side of liquidity, and then like it's not gonna be that the price of the token is zero, because the price is set by you when you create the pool yourself at the moment of the pool creation. So for example, let's go to Dodo. Anyone can follow me if you'd like and do the same. The thing is that the interface that I was dealing with is actually the old version of the interface. So that's why I'm switching to that one, and it's still available through the interface. You can easily set all the parameters and see basically what's happening to your token. Okay, so let's go. Provide liquidity. And let's take a look at the pools that were created. I'm gonna switch to the account that I've been dealing with already, and it's got some BSC in it. Okay. Okay, and so this is the pool that I've been creating previously, but I've removed all the liquidity from it, so we can try to create a new pool to a different token. So for example, previously we used to have a pool of GTON to USDC, and now we are going to create the token, the pool like GTON. Let me check. GTON to USDT. And you see that there are different types of pools. So it really depends on what exactly you are trying to do. But you've got also the additional selection of the way to provide liquidity. So standard is basically you provide both sides of liquidity, but you can select a single-sided one. And this is really great because if we want to provide only liquidity in one token, because we've got one token, we just issued it, then we can go here, set only like 100 GTON, and this tells you what exactly is going to happen to the price of the asset if someone buys it, etc. So these are the parameters that we control: the initial price and the slippage coefficient. So the initial price can be set to like current GTON price, like for example the $2. And this means that people are going to be able to buy it only for 2 USDT, no less. And slippage coefficient really shows you how the price is going to grow depending on these parameters. So the higher it is, the less slippage you've got. But anyway, so the interface is really easy to read because you can see like when you sell this amount of GTON for this number of USDC, what's the token price is going to be. So if you're doing a token sale, it's really easy to adjust the way that price is being affected over here. Yeah, so I'm not sure also how much in details so we should go into here, because like it really depends on whether or not you are interested in such instruments. Or we can take a look at like some other practical stuff that might be really cool, like for example deploying your own Uniswap style liquidity pools. So basically you can get the industry standard that's Uniswap v2 and deploy it anywhere. So for example on testnet. So funny story, like when you talk to developers, they always tell you that everything is like complicated, too much work, etc. This can be done. So like as this is like a panel for VCs or some people that potentially are going to work with developers, and you have to understand that not everything that developers are saying is true. So for example, when we when we wanted to create our own infrastructure on testnet. So if you go to like CLI test, CLI GTON Capital, it's basically like the interface for interacting with our smart contracts. So when we are developing our own products, it's the core thing to realize is that when you are building in DeFi or like in crypto in general, the core of your entire business is smart contracts. So you shouldn't like develop these products as in traditional markets. So everything is done simultaneously. You work in the interface, etc. So you have to set your priorities straight. So that's why we've decided to focus completely on building the smart contracts first for all the contracts that we might need. So basically for the DeFi product that it's like in the field of DeFi 2.0 with the focus on protocol-owned liquidity, basically, so that we don't rely on the rented liquidity. So, for example, if someone's got the money, they deposit this money in the liquidity pool. It's called borrowed liquidity, and at any moment in time, people can come and take this liquidity out of the protocol, and basically, well, the protocol can even be dead because of this, because this might highly affect the price. So, for example, if the required liquidity is removed, then any sale leads to the sharp drop in price that's going to be reflected on like all the trackers, CoinGecko, CoinMarketCap, and people can start panicking and telling that you are rugging us, etc. So they're going to sell the token. So that's why we are switching the narratives to actually protocol on liquidity, POL, so that the protocol's got the majority of money. So the majority of money in the liquidity pools is provided by us and not by other people. So this way we are more flexible at what is happening to the price. We're more stable because we always know that the liquidity is not going to be removed overnight. Yeah, but anyways, so we are building infrastructure of like the stuff that allows us to increase the treasury so that we can manage the funds correctly to make new products and grow the token. So we are building the base contracts that are staking to get some rewards for GTON holders, bonding that allows people to buy bonds, and basically it's discounted GTON. We take the current market price that's done on chain through our decentralized Oracle's network, and we are selling you GTON at discount relative to the current price, which is basically for people, it's not guaranteed profit because the price of GTON is volatile, but you are fixing the price at the moment of bond purchase. So if GTON goes in price, you are profitable. If not, then you might lose money, even though you are getting more GTON compared to what you could have bought right now on the market. So anyways, these are the ways to increase treasury, etc. So fun instruments to work with, but you have to realize that you don't need UI for this straight away, because for people, like for the interested people, they're going to learn how to work with our CLI interface, for example, while we might have spent like an additional 2 months working on the UI, and if we don't see the market traction, then anyway, it's not gonna move us forward anyway. So we test everything on CLI, and then once the infrastructure is done, once like all the investors can, well, they already can interface with the contracts. In this way, the retail people are going to come later when we build the UI. So here you can see that there are several ways to interact with the infrastructure that we already got. So you can tap the help command and see what's available. So we've got easy stuff like, for example, the join command allows you to connect your MetaMask. I'm already connected here, so that's why nothing happening. But if I try to disconnect and type join, it's basically going to do the same stuff. that's done on every other crypto website. Basically, it connects the state of your website to the state of your wallet. And then you can do stuff like buy GTON, sell GTON, etc. And so initially, when we've been developing the new feature, for example, that we wanted to allow people to easily buy our token, because previously you have to basically find some FTM tokens, fund them to your account, because we're doing all the swaps on FTM. And people would have to go to the external service. You have to guide them through the whole process of how to give the approve, etc. So they basically have to rely on like a new interface that they might not be familiar with. So this is like the sales funnel, and we are losing people here. So we've decided to add the functionality of buying the GTON straight away on our website. And basically what you have to do is like say, buy 10 with FTM. It's like human readable stuff. Okay, and it's not active here. Maybe we've been expanding our UI, so basically the number of commands has been growing, and that's why we've created the subdirectories for this stuff. Okay, so buy isn't here, so it's probably in the staking stuff. So the terminal style navigation is like we go to the directory staking, which was actually mentioned here, and you can go to the staking functionality. Then type help, and see the available commands here. So you see the buy command is actually in the staking subdirectory. So I can type buy 10 with GTON. B is FTM. FTM, of course. And yeah, my account is not funded on Phantom testnet, most likely, because or not. Yeah, so here it is. So at first I give the approval on the Phantom testnet, you see, for the tokens to be traded. And then, okay, yeah, because it's FTM, it's native token, you don't need the approval. So I was mistaken, we've got the same. So we can do the same with USDT, for example. So in our tests, like we need to replicate the entire infrastructure that we've got on mainnet. So before going live and allowing people to basically trade with their own money, we needed to make sure that the UI is connected correctly to the interface, and that the transactions go out perfectly. So when I told that we need to test this functionality, developers told me that this is very complicated. We cannot create the pools on testnet. It's impossible, etc. Then I've gone on and like basically done it myself, and it turns out to be really, really easy. So with the current like advancements of the tools that are available for developers, you can basically get any code that is of interest to you, upload it to online IDE called Remix. Basically, it can be done even on the computer where you don't have any specific tools except for the web browser and MetaMask. And so I've gotten the Uniswap v2 pools code, deployed it on the Phantom testnet, created a pool of GTON to FTM and GTON to USDC, and basically connected these new smart contracts to the web interface over here, so that we can actually test the entire flows of what might be available to users in our mainnet, but on testnets. And so prior to, if we've got any changes, for example, we run the suite of tests, check that everything runs correctly. We don't have issues with like different like values calculated improperly, etc.
So yeah, so this is a story about like how to properly test your applications and that you can easily replicate any infrastructure on testnet without like needing much of like programming knowledge, etc. So let's probably go ahead and do the same stuff. I'll show you how to create the pools of your own. So if you've got laptops, you can probably take them out and try to follow me in what I'm doing. But basically, all you need to do is, like, for the pools, for example, the base implementation is the Uniswap v2. And you can Google Uniswap v2 contracts. And probably can add GitHub here, but anyway, it doesn't matter. It's the second search result that we are getting. And the repository is called v2 core. It's basically version 2 of Uniswap that anyone can use given the permissive license. And you can go to the contract subfolder and see that this is these are basically like the base contracts that are going to be used by people, by you when you are uploading it. So we can get back to the main repository here, click it code, and there is download zip. So basically that's what we need, the current version that's not been changed, by the way, since 19th of May 2020, because these are smart contracts. They are permanent and people don't make that many changes to the code base once it's deployed. Also, it's a good fact that since like the last commit on 19th of May 2020, no changes needed to be made. So Uniswap v2 is basically considered very secure. That's why just taking the straight up fork without changing any line of code is like the preferred line of action, because there were instances of when people cloned this repository, for example, and tried to change only like a small like one line of code, and this is the opportunity for the potential hack. And people were exploited for like millions of dollars because of a small change to the contract. So if you are changing something, then you have to be proficient in coding, and you have to make sure that you write additional tests that this doesn't mess with the logics, and also that the previously created tests by Uniswap are running okay. So anyway. Yes, so it's it's actually complicated better because, well, of course, the smart contracts by default are immutable. So once deployed, the contracts cannot be changed. And if they're changed, it's only through new deployment, basically. And you have to make sure that people know about this new deployment, that the previous deployment isn't exploited, so that the funds are extracted from the previous account.
Migrate your liquidity to a new version.
Yes, so that's why actually there should be some protections in place if you are not sure if your code is 100% like, exploit free. Then there should be ways to, for example, stop the contract, which we do have in our staking contract, just in case that if we see that the money is being drained from there, that we can easily run one command, stop it, and the new transactions are not going to go through. Also, a good word of advice, like if you are dealing with the developers and they are deploying the contracts on your behalf, then there should be a way to transfer ownership. So for example, some of the functions of the contract can be named as, can only be run by the admin or owner. So yeah, in majority of cases, it's good, it's an okay way of doing things that developers deploy the contracts themselves, but then the ownership has to be transferred to, for example, a company multi-sig, so that it's not one account that can easily be compromised. So if your ownership structure is that one account with one seed phrase is the sole owner of everything, then if somehow someone exposes this seed phrase, that one person can easily like rug you, take all your funds, and be gone. So that's why it's always good to have a Gnosis safe, for example, make it the owner of the contract, and then interact with the contracts only through transactions on Gnosis. So that, for example, like 4 out of 7 people have to sign the transaction, otherwise it doesn't go through. But anyway, so we've got the repo here. And let's see what the code might we need. Okay, I'm gonna clean up here a little bit because we need all of this stuff. Okay, no. So these are old contract of ours. And basically the core that you need is all here. So the easiest way to go is actually to go to remix.ethereum.org, and basically this is the online IDE created by Ethereum Foundation that allows you to run code, see if it compiles, and also deploy it straight away. And the good thing is that it's integrated with MetaMask, so basically if you add a new chain on MetaMask, you can deploy the contract there easily, no problems whatsoever. So let's see, let's just create a new folder called Uni v2. Okay, it's not a folder, let's delete it. Okay, the directory can be created here, and this is the Uni v2 we need. We're going to put all of our code here. So the thing is, in the majority of cases, the paths that the files are dealing with are relative. So for example, if we add these 3 base contracts that we are using over here, so we can add files using this little icon, go to core, master, contracts, and these are the 3 base contracts that are needed for Uniswap deployment. We add them, and then you can see that it imports some of the files in the directories of the relative path. So basically, we need this interfaces folder in this Uniswap v2 folder. Otherwise, they're not going to see the file that they need, and it's not going to compile. So basically, if we need, for example, the v2 factory here, we try to compile it. Okay. Most likely, it of course not going to compile. First of all, I've set the wrong version of the solidity, and that's why the compiler version mismatch is not going to allow it to do anything. And then something bad is happening that it can't actually finish anything. But anyway, we didn't have enough files over here, so it was never going to be compiled. So we create 3 folders of the same names here. So the interfaces, the libraries, I just copy the names and paste it, just, oh, okay, it's create subfolder. That's not what we need, so we have to check the Uni v2 once again, press here, and this is how we create a new folder. And then the last one is test. So we once again select the Uni v2, create test folder. That's actually not needed because the tests are not going to be run. But anyway, and we upload the files to this particular directory. So test, we create test here. Libraries, we add files from the libraries directory. And interfaces, we go to the interfaces. Maybe, but yeah, this is like the manual path that I'm showing. I'm actually not sure, so
yeah, there's like an import.
there is, but yeah, I've never tried the complete import because I mostly deal with several deployments over here, and I'm not sure how it's going to mess with the folder structure. But yeah, probably you can use these GitHub
import yourself or do it manually, as I've shown you. But anyway, so now we've got all the code necessary here, and we can try to compile. Okay, the compiler is a bit sketchy. It's not doing what it's supposed to be doing. So let's switch once again. So you remember that we have to check the Solidity version. So it's written over here. So we need Solidity 0.5.16. Now the current Solidity. Okay, so something's happening, and it doesn't allow me to change the compiler, which is really strange. So normally you are able to compile it with the selected version of Solidity, but for some reason it doesn't allow me to change it. That library. Okay. Sometimes this happens in programming. Unfortunately, the tools might not be working the way you expect it. But anyway, okay, let's see what we can do here. Try to reload once again. Maybe the problem with the Wi-Fi or something. I'm not really sure. Give it to Perm. Okay, okay. Yeah, it's just some hiccup on the UI, but now we are able to select the appropriate commit of the compiler and try to compile. You see, so we didn't get any issues, so the contract compiles perfectly, and basically this means that we can deploy it on our testnet. So for this purpose, I'm going to use Phantom testnet. I've got some test tokens. By the way, you can get test tokens easily on faucet.phantom.org, if I'm not mistaken. Or just Google faucet phantom. Okay, let's do it this way. Okay, phantom.network. And you enter your address here that you copy from your MetaMask, for example. Prove that you're not a robot, and record the FTMs. And you are going to get a drop of 5 FTMs like within seconds, you see. So I had 9, now I have 14. So basically we can use this to deploy the contract on using Remix. So we go to the deployment tab and select the environment, which is gonna be not the JavaScript VM, but the injected Web3. Basically, for these purposes, it connects your MetaMask account, uses the network over there, and basically allows you to upload code to any EVM network that is imported here. So I've selected the wrong address. I'm going to do it with the test address of mine. Or probably we can just send the phantoms like this to the contract that we need. It's a deployment contract. Let's go send 10 of them there. Phantom is really fast in this regard, so you can easily send the tokens and the transaction goes away pretty quick. So yeah, the tokens are already sent. So we've connected this account here, and now we can run the deploy. So for these purposes, you have to choose which contract you want to upload, and in our case, we're going to be uploading Uniswap v2 factory. So when you, not the interface by the way, you have to choose the real contract, and I've accidentally used the interface, which is not correct. So let's go Uniswap v2 factory. You have to compile it first. So I'm going to the factory contract over here in the code, then go to the compile tab, try to compile it. It's compiled well.
Yeah, there's also like an auto compile thing setting.
Yes, that as well. That as well. But anyway, so we see the factory contract over here, selected, and just have to set several parameters. So if you take a look at the code of Uniswap Video Factory, you have to look for the constructor, and it's got basically one address that you have to set, and it's fee to setter. Basically, the contract that's going to get all the fees out of the trades that are happening on these DEX. I'm going to use my own address that is deploying it. So you have to enter the parameter comma separated over here if there are several parameters. And then we can click deploy. Basically, this is gonna ask you to create a transaction, and it will try to deploy the contract on chain. So as you see, actually the deployment went through. This is the information. This is the transaction hash that we can see at testnet.ftmscan.com. Basically the explorer of the chain that you are using. And you can see the transaction, what exactly happened here. And you can see that the contract with this address has been created. Currently the contract is here, but you cannot interact with it easily because it doesn't got the interface ready available. So for these purposes, we actually need a plugin that's called Flattener. If you go over here, you can select one contract that you want to flatten. In our case, it's Uniswap Video Factory. And basically what it does, it creates a new file with all the code that relates to that particular contract, and we can use this code created by the flattener and use it to verify our contract on the testnet. So if you go over here, basically anyone can do this. It doesn't matter which account you're connected to. You press verify and publish. Select the compiler type, which is single file solidity in our case. Compiler version, it's 0.516, if I remember correctly. I think so. Okay, and you select the license. I think it's like it was MIT or something. And yeah.
Uniswap is probably GPL. Doesn't
No.
matter.
GPL is restrictive. And so it's Uniswap v3 that is GPL.
Really?
Yeah.
Doesn't matter.
Yeah, GPL is like the contract that means that you cannot use the source code, and if you create any modifications to that code, that you always have to publish the modification that you are doing. Maybe there is a different type of license, because in Uni v3 don't even allow forking and creating anything of your own.
They
Yeah.
Modifications to this.
Yeah. But anyway, so we are back here. We enter our code. It might ask for constructor arguments. I'm actually not sure if it's gonna ask it in this particular situation, but let's see. So I verify that I'm not a robot. I am not a robot. And then we see what the result of this compilation is. Yeah, okay. So we've got the error here because it couldn't decode the bytecode. So in this case, most likely the issue is that you need to provide constructor arguments in the ABI encoded style. So for this, you go to the instrument. Okay, I think it was over here. ABI encode params, and there is parameters online. This is how you look for the tools. They do the online stuff for you, and basically you can go over here, and there's a portion that asks you to if you want to enter parameters manually. So it's a constructor. I'm adding an argument of type address, one address, not the array of address, just the address. And I get the parameter that I've used. The parameter with my address. So I'm entering it here. remove it. And this is the string that we need to use on Phantom scan. And let's see if it's verified. I hope it is. It is. So you see, basically, we've already uploaded one of the contracts that we need. Okay, of course, for Uniswap, you might need something else, like the routers that you can find in a Uniswap v2 periphery repository of the GitHub organization. And anyway, so you can already interact with this contract because you have uploaded the source code, and so here appear the read contract methods where you can find like all pairs related to one particular address of token, or you can write contract, and write contract basically allows you to create the token pairs of your own. In this case, actually, it's not preferable to create the pairs yourself, so it's better to make sure that the pairs are created through the periphery contracts. But anyway, it's possible to create a pair for new tokens. You just enter 2 addresses, and it creates a new token for you. You might, using the periphery contracts, you can also create pools to the native token, which is in their terminology called ETH, but in general, like it's just the native token of the network that you're dealing with, and you can basically provide liquidity. In one transaction, you try to provide liquidity. The periphery contracts take a look if the pool is already created for that pair of tokens. If not, it creates a new pair of tokens. Basically deploys a new contract for you, which is an ERC20 token that I've mentioned before. And then you can interact with that pool. So this is exactly what I've done in our case. I've created uploaded all the contracts that we need, like the factory, periphery contracts, created a pool using those, uploaded some liquidity in FTM and test GTON token that we had. And now we are able to do like just any types of swaps or any types of transactions on testnet. Currently, we are deploying the same infrastructure for DODA swaps that we are working on, and of course we're starting with testnet because like if you've got the new code and you're not sure how it's going to use it, so you always have to use both automated testing and manual testing to make sure that your code works well, and this is better done on testnet, so you need those skills. But anyway, just know that this stuff, deploying contracts, is fairly easy. Like with you, in like 15-20 minutes, we've uploaded new contract easily on testnet, verified it. You can now interact with it using only one tool, is basically the explorer of the network, and you don't even need any type of UI whatsoever. Just upload the contract and verify it. So I hope this was helpful. I think I was told that we are supposed to be ending things now, but if you've got any questions, so we are ready to ask as well. Thank you. And if anyone wants a repeat of all of it, we're holding the second workshop a bit later. Another 3 hours of fun.
Don't do it. Don't be back. Is it going to be the same subject? Absolutely.
Yes, but it depends on the audience. So if you've got more questions on the second one, we can restructure it. So probably we'll try to interact with audience first, like ask what exactly are their priorities, and then adjust the presentation accordingly. Because we've got a lot of information. Probably like the most hands-on information that we've got is about our own product and like the way we are developing it. So this is what we can talk about, share our experience, and I think this is like the main stuff that you need, because hands-on experience is like the coolest stuff in the world. Yeah, but as I'm telling you, it's not hard at all. So I didn't know like at all like Solidity half a year ago, and now I'm able to upload contracts, etc. It's like once you realize that it's easy, it's just all the mechanical stuff that needs to be done. Then
Yes, but at the same time, you remember that I wasn't like computer science major, so I didn't have any like computer science experience whatsoever. So I was learning everything from scratch. And especially like if you are talking only about the deployments, so not about like writing the code, because of course if you are trying to write new smart contracts and you want them to be safe, then you need a lot more knowledge than that. But at least you can start from something. So either you can deploy your own ERC20 token, for example. It might be used for any purposes. So for example, you know Patrick, the main organizer of East Dubai. We met him at DeFi Dubai meetups that are happening weekly here. And basically what he's done, to know the place where the meetup is going to be, you have to interact with the contract that's deployed on Ethereum or like Arbitrum and Avalanche. And you basically have to call one function called RSVP. And after that, you can call the view function that returns the URL with the information of the address where it's going to take place. And at the same time, he issues you 100 DDD tokens, like DeFi developers DAO or something. For now, it's not worth anything, but at the same time, since it's at a good community of DeFi builders, by the way, the DeFi meetups that are happening there, they are really awesome. You can find like cool people that are doing insane stuff. Like for example, creating the first ever centralized crypto exchange here in United Arab Emirates. So the licensed one in Abu Dhabi, like getting licensed is Abu Dhabi is insanely hard. And you can talk to people like this on those meetups. But for this, you have to know how to interact with the contracts. And the easiest way to do so is actually with the scanners. So all you need to do is have some tokens. Of course, Ethereum is a bit expensive for these transactions, but if you've got like Arbitrum, ETH or something, you can interact with the contract there. It's fairly cheap. You can participate in the meetup, and also like you can use the exact same skills that you've learned today if you didn't know it, and yeah, go visit the meetup.
Is GTON Capital B2B or B2C? Like you are an infrastructure provider, right? Providing it to like other DApps, or you are providing it like you are giving it to the end consumer?
Actually, like mainly, I think we're consumer app because like we're building DeFi infrastructure currently. Of course, yeah. Of course, we need like institutional developers, etc. But I mean investors, so that we can grow. We need contacts in this space, but at the same time, like the product that we intend to build are easily usable by anyone. It's like we're also creating a stablecoin, algorithmical stablecoin. In the nearest future, like people who work with us actually launched one of the first algorithmic stablecoins called Neutrina on Waves Exchange. We already mentioned that, and so we've got experience in that. And basically, like at the core of our business is the DAO itself. So surprisingly, like we are a DAO that acts as a DAO, so we hold votes, and we've been even fucked by a little bit by our early investors. But yeah, because there was a vote that, well, we at the team didn't approve of like initial tokens unlock, because when we had a good traction at the very beginning, and the price of the token went up like a lot, and then sorry. Yeah, but they were unable to sell because there were limits on withdrawals of the accounts that were spread over the year. But since those early birds are the main holders of the tokens, they were able to create a proposal proposed these early birds unlocked. So we as DAO had to unlock the tokens, and basically the price dropped afterwards. So that's why we had a little bit of a problem with the traction, but it's actually good. So you see, the DAO model works, surprisingly. Unfortunately, it's not always in the favor of the organization, but lately, like all this stuff, so we've been initially involved with like bridges, etc., and we wanted to build cross-chain infrastructure, but then decided that this is not the focus that we want to work with, and so we suggested to pivot into what the vision that we currently have today, and at the core is like algorithmic treasury management. So in most of the DAOs right now, the treasury is like a little bit shadily managed by some people. No one knows what exactly is happening with liquidity. We want to make sure that like the team doesn't have access to all of those funds directly. We have a really small burn rate right now. The majority of tokens are supposed to be used for liquidity, and basically we want to make sure that we don't do this manually. So right now we have to manually go on like Spirit Swap, Spooky Swap, adjust the liquidity on the pools of to USDC FTM by hand. It actually like sometimes arbitrarily, because yeah, you basically adjusting everything as you go. But we want to build the infrastructure to manage everything automatically. So the smart contracts run our treasury management. All the pools are created properly. If you get new funds from like through instrument like bonding, that this money is used to increase liquidity and is accounted to towards the token price in proper ways. So that's why we're using DODA.
Can I just add something to respond to your question?
So basically, GTON Capital itself is a
DAO of DAOs. So we're going to have a bunch of projects being launched like in this year. And so each of the sub-projects will have its own infrastructure deployed. So in principle, it means that the protocol that we built, which is called Pathway for algorithmic pricing of our governance token, can be reused multiple times. And we're going to test it during this year. And actually, have you mentioned our next plan we can store for Q4 in terms of GCNet?
Oh yeah. The ultimate goal is actually, so we want to make sure that with the treasury of ours is used properly to grow the products, and so that there's some innovation happening. So the best way to provide this is actually that other builders can build on your infrastructure, and the only way to do so is actually to have your own chain, because otherwise other people cannot build new products on you. So that's why our ultimate goal is to make the proper infrastructure for creating our own testnet. The new net called GCNet that we are going to welcome everyone to build upon. And if the DAO treasury is used properly, that we can allocate some funds out of it for the grant programs, etc. So yeah, this is the ultimate goal. No. The treasury is basically other tokens, the liquid tokens that we can use to set prices. So we, of course, don't count the GTON tokens that we've got at our disposal as something that we've got as liquidity. But yeah, it's used in our operations, so we add GTON to the pools, etc.
Liquidity, you would not consider that as part of treasury?
No, we do consider it because
There's basically protocol on liquidity and protocol on assets. So
those that are being used in liquidity pools, we count them separately. Actually, each month we publish treasury reports. They are open in our documentation.
On treasury versus protocol on assets.
yeah, just assets that we have.
For instance, on like a multisig, it's not being used for providing liquidity, and there's a difference between those assets that we put.
What are they used for?
Just for infrastructure, for loan costs, etc. So that's part of the treasury.
That's for your expenses, basically.
Yeah.
No. The majority of funds are theoretically for market making.
Yeah, right. There's like small
Yeah, yeah, yeah. But
It's used for two purposes: market making and expenses.
yes, yes. But we've got limits for everything. And we've got limits on how much we can spend on the team, etc. And we try to be
designed by a smart contract, or this is just internal?
internal. Yeah, but we've got everything set by the award of like what is the allocation for the team expenses, for example. So I was told that we've run out of time. Thank you, everyone.
Yeah, thanks a lot.
It was really nice. Thank you for the questions.